Welcome everyone, and thank you for tuning in. Yesterday, I met a client. He came in for a early mid-year review. We noticed that his 2024 vendor contract are quietly bleeding his business dry. Now he has remainder 7 months, and the scary part is he did not even notice until we brought that to his attention. If he does not force the seat at the table right now with the vendor, stagnant agreements, sticky inflation will definitely eat up all of his remaining margins. It is time to stop being passive player in your business. It is time for you to proactively designing the survival steps for this situation, what we call it sticky inflation. This is why I'm here to discuss how to survive sticky inflation. Just like everything else, one, it is sticky, one, it is last longer, and you start to accepting it. So the gas price goes to 4.5 per gallon, you accept it, and your vendor selling your things with higher price, you accept it because it is a sticky situation and you learned to accept it. But however, your business, you don't automatically reprice your business product and you're running your business as normal. But on the other hand, you're not dealing with sticky situation. That is where you're going to discover at the end of 2026, suddenly you say it's not worth of doing this business because I'm not making it. You're not making it, it's not because you did a bad job. Your sales might exactly be the same, but your cost is out of control. So now, if you're waiting for economy to normalize, you'll run out of the runway first. The 2026 inflation reality check here for you. Sticky inflation equals to cost plateau high and not backing down. So current price plateaus are hidden cost increases for business. Why? Because your revenue don't automatically reprice while your expenses stay plateaued and high. Inflation can cause standard multi-year contract from the past years, like from 2022, 3, 4, to drain the margin because it was the contract from before. It dragged down to 2026. The price is not realistic for you. The old contract become your profit traps. This is where we see with our clients. And that's why we put this webinar together to warn business owners to watch your contract and wait for the rate to drop is no longer a viable survival strategy because it is not going to happen. And we are in a upward inflation, and you know that interest rate don't back down and the costs continue to go up and the business is feeling the hardship. So there is a three numbers to watch weekly that I want you to do to help you safeguard your business. Most business don't fail from lack of sales. They fail from margin compression and the cash timing. Run out of cash, could not keep the door open, no more profit, not worth of doing anything. So those are the things you hear from small business owners before they close their doors. So what are the three numbers we want you to watch? Number one, gross margin. Number one, gross margin. Gross margin, it is an indicator whether you still have a viable business. For example, if you run a restaurant, your sales price is $100. You made $100 sales. Your gross margin at this point only gonna be the counting on the cost goods sold, your ingredients, the produce, and those things you bought to produce your dishes. So if that gross margin, which is a cost goods sold, divided by your sales, if it is that more than 50%, you don't have a viable restaurant to run because that means that material itself already eat up all your possible margin. We haven't even count. Gross margin is not your net profit. You still have a lot of things to expense, like salaries, rent, utilities, all of those things. So with that said, and what you got here is your 50% of gross margin is not going to work for you. You're looking at least 70%. So cost of goods sold is 30%, which is healthy. So your gross margin is 70%. Gross margin is number one you want to watch. But of course, if you say, Ying, I'm running a service company, I don't really have a cost of goods sold. What is my gross margin? I would recommend you to calculate gross margin using your labor cost because you're a service company, right? So you have a labor cost that has to happen and you're not using old robots yet, right? So you use that amount and to calculate your gross margin. Cash runway is another important number to watch. So what is cash runway? Cash runway is weeks of cash left at a current burn. Your current burn are the expenses you can't escape, like your rent, your labor, and your utility, as long as you keep your lights on and you have these expenses. So you need to know what is your minimum weekly burn. That is your runway. You look at your bank, you look at your weekly burn, you know that how long you're going to last. So normally in a service company, and we want to see you have at least 8 weeks burn because the service item would take more than a week to produce. If, for example, in a CPA firm, and you want to do a tax return, if your only business is tax return, then you know that turnaround time is probably 2 weeks, because from the data collection all the way to preparation until produce the final tax return, 2 weeks to 8 weeks. So with this kind of timeline means that your product don't come out every day. You need to have a weekly burn to be estimated at least 8 weeks. Otherwise, you can't even produce the dollar yet you already run out of cash to run your business. So the cash runway, the weekly burn rate, that is something you need to know for your business. If you happen to have a business, you're just have such a creative business and you're like, Ying, I don't know what is my weekly burn. You bring me your financial statement, we'll fix for you. We will calculate it for you. Price realization. Price realization in this context is your actually collected amount versus the invoice you sent out, you hasn't even got it. It's also called account receivable. A lot of small businesses are on cash basis, so you don't count on account receivable. You just, count on the money you got. That's okay, but you want to know the total revenue that you expected to get. So that is also an important number to understand. Historically, you can say my realization rate is 80%. Now, you send out $100 invoice, 80% realization rate just means that you're only going to get $80. So that is how you're going to calculate whether you can sustain, whether you have enough cash runway for your business, right? So I wrote the formulas on the screen. So gross margin equals to 1 minus cost of goods sold divided by total sales. Runway is a cash on hand divided by average weekly net outflow, like net money out. You know how to calculate all your expenses, right? The price realization, like I told you, is total revenue divided by the account receivable, the one that you invoiced out. I also give you another easy number that is cash on hand. So don't just look at your bank account, goes, oh, that's my cash on hand. No, your bank account, of course, plus the money you keep in your pocket and minus the checks you wrote, people hasn't cashed out yet. So just really understand your number and be comfortable or uncomfortable with your number, because those feelings will bring actions. If you're comfortable, you're probably not going to be so worried. But if you're not comfortable, this is when you start really digging into your number. Make sure your survival rate is there. and you want to survive. In every recession, depression, and the inflation, economic change, up and down, left and right, with every storm comes with newborn businesses. Businesses is like in every situation, there are successful businesses, folks. So it's not like when the gas price goes up, business all fails. No, when gas goes up, there's some business are prospering. Those business will triggering down on their expenses. So some vendors are still making good money. So you just want to figure out in this particular situation we're in, we're still, struggling with the economy. We don't have any ways to alter the situation. But as a small business owners, as a successful business owner, and your thinking need to be very flexible. So with that said, and it is always you needing to watch your cash flow, see whether you have a way to go forward. If not, start thinking alternatives. So if you're lacking of business, you can always engage a conversation with your CPA, with us, given current situation, what would be our next step? What would you recommend? And trust me, in doing CPA businesses for 30 years had taught us how to look at business and audit your vulnerability. So this is a concept, right? So everyone wants to, in business, we try to prevent IRS come to audit you, right? So you always are in the defensive side to make sure that you follow all the rules. So if IRS come to audit you, you feel your back is straight, you're not worried. Same thing. You want to prevent yourself from being vulnerable. So you want to audit yourself, see what is your weak point. So identify the top 10 cost lines on your financial statement. The top 10. Just identify them, okay? And mark them this way. Are they contracted? You cannot change. Are they variable? Depends on your sales, or depends on your labor, or depends on your cost of goods sold. So are they a changing factor based on whatever you are doing? The third one, labor driven. Are they related to the people you hire? Of course, the benefit would relate it to the people you hire. Generally speaking, if you have $100 for payroll, you're going to have 25% of that amount, additional amount for taxes, unemployment tax, maybe the Social Security, Medicare taxes, and all of these, related taxes are coming in. So you do a 25% work comp insurance, all of these labor related things, you get yourself a 25%. If you offer additional benefit like 401k, cash balance plan, we're talking about another 20%. So for $100, you're going to have $45 on the side. So that is related. That is tap into your labor driven, wage guided expenses. So I want you to mark the top 10, label them that way. Then you will work on the contract. And I want to teach you the new rule for 2026 vendor negotiation, contract negotiation. Know your renewal windows and start doing alternative check. Okay, this vendor offers me this. I can get the same thing from the other vendor. The price is different. Check on the price and start doing your own vulnerability mapping. Know what you can save, how you can save. The rule for 2026 vendor negotiation is for you to stop telling the vendor that, oh, go cut your cost, cut your price so I can still be your customer. No, don't say cut your price, because that is putting you on the opposite side of your vendor, and they see you as their disadvantage to have you. No, you are their advantage because you are doing business with them. So what you will say is you will tell them, let's redesign the deal so both of us can win. Okay. So the option you can offer, you can talk about volume commitment. You can do early pay discount. You can clean up the scope, maybe in your contract. In reality, sometimes the contract including things that really you can let go. So change the scope, So that way lower the price. Benchmark technology automations. See whether getting something else would help to reduce the fee. So with that said, it is your job, right? Start looking at that and making sure you negotiate for a win-win situation. However, we also tell our folks that don't negotiate when you are trapped. So when you are trapped in the agreement, there is no negotiation. If you negotiate after renewal, you're begging. But if you negotiate right before renewal, you are choosing. So the best way to do renewal is to do it 90 days before auto renew. You really need to know what is going to auto renew. You do it 90 days before using very simple method to do that by checking the market, figure out what other people would offer you, and lead in a transparency mode, which means that tell your vendor that this is me. You know, I used to be this way, now I'm this way, so I'd like to renegotiate the price with you and be transparent with them on where you are. You want to know that they're sincere and start working with them, come up with this negotiation and with established long-term relationship, locking in that long-term resilience. So that's important, right? Look for alternative, and that's really important. If you want to show up with a market price, you cannot not have one. You cannot guess what other people are going to offer you. You really have to do the legwork 90 days prior. Don't do it after. Don't do it right before, because all of these are doesn't sound sincere, doesn't make it work. So what make it work is you prepare. Long-term resilience, lock that in. Build these into contract going forward, right? So you want to put a cap on the contract, annual increase cap, update service level agreement tied into pricing. So making sure your scope is so clear, cut and dry, so you know exactly what to offer, and a quarterly review, not just annually. In this environment, quarterly is important. Lock in the long term. Negotiate the caps is important. A lot of times, you see that the government are doing that. For example, in California, and in Texas, when the property tax actually has a hard cap, the government cannot raise the property tax to whatever they wanted. So those annual cap making sure that the price don't go skyrocketed. So you can negotiate those caps as well. Update service level agreement to include performance-based pricing adjustment. Performance based can be the vendor performance, can also be your performance. Like if your sales doesn't go up, then what the price should be. If the sales do go up, what the price should be, right? So performance based is very flexible. You can do it on both ways. Don't have to be, based on yours or just your vendors. Establish a quarterly review cycle to ensure your fixed costs remaining aligned with the evolving economy landscape. Who knows? Maybe something came up and your business is rendered invalid and you can't do your business anymore. You think that doesn't happen to business? It absolutely happens to business. So with that said, you want to make sure that you don't tie up with this contract when your business is rendered invalid. Just like the lease agreement, right? Some of the lease agreement is based on the sales of the business inside of that building. So if you don't sell anything, you don't have a lease payment. But if you have your lease payment tied with your name, no other conditions, then even if you run out of business, you close your shop, you still owe 3, 5 years lease payment to the landlord. So those are the things at this time people need, small business owners need to be keeping that in your mind when you sign any contract. Cash cycle defense. Very clearly is the key for running a business. Inflation, this kind of sticky inflations really squeezes three places in business. Number one, inventory going up in price. Number two, receivable. Nobody wants to pay fast. and the borrowing cost, and you have loans, the loan renews in 2026, 2027. A lot of loans are renewing at this 2 years. Your cost is double because the interest rate doubled. So those are the things, really eating up your cash. Small business owners, you want to take the following steps. You want to move to get your deposit and short terms as fast as possible, making sure you collect faster and your invoice faster. Make sure you size your inventory properly and don't overstocking. If your inventory price is going up so high, just rethink how you want this inventory to be. Maybe replacement of inventory to other kind of inventory. So just make sure you don't stock all the cash in the inventory. Then you left nothing to run your rest of the runway and don't have money to pay landlord. You think the landlord won't do anything to you? They can lock your door. Tomorrow you cannot get in. So those are the things that you need to consider. Requote jobs faster when inputs move. So you want to make sure that when you get a job, when you are giving a job quote and you quote into moving fast. If someone will okay your job quote and you impress them with the timeline it's going to be done, and then you can raise the price if I do it faster and I can charge more. So those are leverage you have as a business owner. When you get a job quote for what you want to do, you can also put in those sensitivities on cash and making sure that if they can finish their job early and you can get into production early, then you will share with them on your early stage of production profit margin. So those are the things, and you can be creative just so that you reserve your cash on hand and run your business at the same time reward your vendor. So I gave you a 30 days action plan right here. On the week 1, so there are 4 weeks in 30 days, a month, build your vulnerability map and track 3 numbers, 10 items on your expense. So that's your week number 1. Don't do anything else. Just figure out what are the 10 items that really cost you and track the 3 numbers we were talking about, right? Cash runway, gross margin, and price realization. Track those numbers. Price realization is just your collected revenue comparing to your not collected. And the ideal number, it should be under 80%. So that is your cash side of things. Week 2, renegotiate top 3 vendors. Start 90 days pre-renewal. That means you are going to get other quote. You are going to look into how to reduce your cost. So you renegotiate the top 3 vendors. Number 3, price reset. The bottom 20% margins first. So price reset. When you reset price, you want to sort of know that, oh, what do we reset that to? This is where you're going to make a decision. The bottom 20% margins first. So this 20% is the net margin. It's not the gross margin I'm written here. So what I am saying here is that you sell, your total sales $100. And if you can make $20 at the end of the day, after you pay your cost of goods sold, after you pay your labor, after you pay your rent, and you come up with a 20%, means you got $20 net profit, then that is where you want to be. And of course, if your price setting, if your price reset allow you to make even more than that, maybe that would price you out of the market. So you want to look at your price and try to achieve your 20%. And in service company, I actually ask for 30% in the margin, in the net margin. And in the restaurant business, 20% is very good. So some of the restaurant we know, the small independent restaurant, they're going around 10, around 8%. Those are still restaurants that running really smoothly, but you don't want your net margin to be totally lost. So you want to do price reset based on your net margin. I didn't say that to do a price reset based on your neighbor. You know what I'm saying? Because looking at your neighbors is good, but it is also dangerous because you might sacrifice what your net margin is. If your net margin is negative, you know you're not gonna last, even though you are doing the same thing as your neighbor. Contract upgrade. Make sure you've set the increase caps, quarterly review, and those are the things we were talking about, remember? So these are the four things in 30 days that you should do. You must know the sticky inflation rewards the prepared. If you can control your contracts, control your pricing, and understand your cash cycle, and you stop being a passive payer, and then you become a prepared business owner dealing with sticky inflation. With that, I want to introduce you to our website, communitycpa.com. You can book appointment with me right on the website, and you can also book appointment with other folks here. I am showing you the two I circled up are our tax experts, and you can also talk to Dr. Howe. Dr. Howe is in charge of compliance. If you get audited of all kind, you can contact Dr. Howe. And Dan is partner, and he is in charge of the client service development. So he is leading our legal team in our firm. So you can definitely get legal services at our firm. And we have Stephanie Howe as our attorney, and she works closely with Dan and to provide that legal side of service to you. And then you have Kwan. She's in charge of our payroll side of operation, and also oversees sales tax and also and accounting. And Eileen and Kwang are working in the same team and to make sure that every accounting client in our firm is going to have their financial statement interpreted to a everyday action item. We don't just do numbers, we interpret the numbers. And of course, Derek is our IT partner, and all of the technologies we have in our firm, and credit goes to him. So he knows what we need to have. He knows how to increase efficiencies so we can lower our cost on labor. When we lower our cost on our labor, it's benefit to our client. So that is what we are doing every day, nonstop. I have 2 books on Amazon, and you can learn what we know in business world. And with YouTube channel, this is where we have all our videos deposited right here. You can search and find the topic that relevant to you. Last but not the least, the webinar is for educational purposes only and not constitute to be the tax legal accounting advisors. Be sure to review any decisions with your CPA or tax advisors and your legal counsels when you are ready to make critical decisions. So we are here to help you with critical decisions. I'll see you soon. Thanks.